Today we are going to discuss rest of the concepts together with the various conventions that are going to be commonly used in the syllabus of class 12th. So, without involving you in the rest of the things, I am going to start up with the things as a dual aspect concept. So, I will request the sir to please throw some light on the dual aspect concept of accounting.
Thank you, Dr. Piyush. Dear learners, as you have studied, few of the accounting concepts like money measurement concept, business entity concepts and other concepts. In addition to them, this is another concept which is called dual aspect concept. The dual aspect concept means every transaction affects two accounts at the time when the transaction takes place, and one account receives something, at the same time another account gives something or pays something. One side is benefited, on the other hand another side is loses something. So, by this way we have prepared one equation that is called accounting equation for this purpose, that is called capital and liabilities are always equal to assets, or in other words we can say the assets are always equal to liabilities and capital. Here capital means the investment made by the proprietor or the portion of the investment made by the proprietor is called capital, and then at the same time he may borrow the money from the loan from the outsiders, and other supplies also can be taken on credit. They are known as creditors. Creditor term is actually used for the persons who supply the goods on credit only, and other persons who provide the loan, they are called lenders, but both of them are called outsiders liabilities, and capital is called owner's liability. So, by this way the total of capital and liability is always equal to assets. Assets means the things which have been purchased or in which the money invested by the proprietor or the lenders has been used, they are called assets. The dual aspect concept means everything affects two accounts, and the accounting equation always remains in total same both sides, capital and liabilities are always equal to assets. For example, if we take the proprietor invested money rupees 50,000 in the business. So, by this way the asset side will increase in the form of the cash, and on the liability side the capital will increase by the same amount. So, by this way we find that both the sides are equal. On the other hand, if the goods are purchased on credit, so stock of the goods will increase by the amount, the same amount will be increasing in the form of liabilities or creditors. So, by this way again we find that both the sides are equal in the total.
Now, I would request sir to please explain the significance of this dual aspect together with one example.
The significance of the dual aspect concept is that at any time the proprietor or the persons who are the management side of the business can know the position of the business, whether the total of the assets are equally available to the other side of liabilities and capital, because the investment made by the proprietor in the form of the capital and the borrowed money from the outsiders must have been used in purchasing the assets, and these assets are of different types like fixed assets, current assets. So, some money might have been invested in purchasing the fixed asset, or some money might have been used in running the business for the sake or use of current assets. So, by this way at any time you can know the position of the business, whether the assets are equal to the liabilities and capital or not, and this is the main significance of the dual aspect concept.
Now, sir, I would like to request you that there is another concept of realization. What is that exactly, the concept of realization?
The concept of realization is the concept that we should enter only the transactions where we become entitled to get something or charge something from the other party. For example, if you have discussed with some party that I will sell the goods and he will purchase the goods, so in this case until or unless the goods are not sold or the goods are not transferred in the possession of the other party, the sale cannot be recorded in the books of accounts. It will not be called realized amount. If you have sold the goods and he has purchased, even the payment has not yet been made, then that transaction will be recorded, because you have become entitled to charge from the party to whom you have sold the goods. It is known as realization concept.
Sir, what is the significance of this, and what other example can you quote to have it much more clarified?
If you have interviewed a person and you have offered the post, but he has not yet worked, then he can't claim anything from you. So, this is not be considered as a realized amount. If he has worked, either you have paid the amount or not for the salary for the month, but he has become entitled to charge from you, then it will be an example and will be recorded in the books of the account as the concept of the realization.
Sir, please explain the meaning of the accrual concept to our learners.
Accrual concept is a concept where we become entitled to charge something from someone other. If we take a case, someone has worked in your factory, but the payment has not yet been made. Generally the accounts are prepared on 31st of March, and the salary for the month of March not yet been paid to the employees. So, if we will be preparing the accounts or closing the accounts on 31st of March, then the workers who have worked in our factory, to whom the payment has not yet been made, their salary have become accrued to be paid. If someone has become entitled to charge from you, it is called an accrual concept. It comes under the accrual concept. Moreover, if anything is due, say the rent of a house for which you have not yet paid, but you have lived in the house, then that is an accrued rent. Accrued means the charges which have been not yet been paid, but the parties have become entitled to claim, that is known as accrual item transaction, and this concept or thinking is known as accrual concept.
Now, sir, there is another concept which has been there in our syllabus as a matching concept. What is this matching concept?
My dear learners, you will be knowing the meaning of word matching. Matching means comparing of two things. Here in accounting, everybody is interested to know the amount of the profit or loss. For that very purpose, at the close of the year or during the year, as and when it is desired, everybody tries to know the surplus or deficit of the business. For this very purpose, we will have to match the revenue and cost. For the purpose of revenue means which is the main item of your, which is the main source of your income. Like in case of a trader, the sale of the goods. Goods is the term in which you are dealing. For a furniture dealer, the furniture is a goods for him. For a machine dealer, machines are. For a car dealer, cars are goods for him. So, if he sells a car, then it is the revenue. But its price is realized by him from the buyers, that is revenue for him. And what is the total cost to that car which was sold by him, that is called cost of goods sold. And cost of goods sold is calculated in case of a normal case of a trading, how much opening stock we had in the beginning of the year, if any. It is not sure that we will be having, if the business was started during this year, so the question of having the opening stock does not arise at all. So, if the business is an old one, then you will be having some opening stock. At the same time, you will have to find out the total amount of the purchases, either they are on credit or on for cash. Net purchases means total purchases less purchase return. And then at the same time, if you have incurred any amount, paid any amount to meet the direct expenses like carriage inward and other expenses, wages in factory for making the goods saleable. If you have incurred any amount, they are known as direct expenses. So, opening stock plus net amount of the purchases plus direct expenses, and then out of this total we will have to deduct the closing stock. That is, the remaining amount is known as cost of goods sold. So, the item which you are selling, that is matched with the cost, and that is known as matching concept, matching the revenue with the cost. It is known as
Learners, what sir has explained is absolutely right in this regard, that you have to simply match your revenues with your expenses. Then only you will be able to know your exact profit or losses for the business. For example, the expenses for a particular period, in case of the insurance is always going to be paid for a particular period of time, and that is say for 1 year, while the period for which the business we are having is going to have just 6 months. Then the remaining 6 months are not going to be considered as the expense, but they will be carried forward as a prepaid expenses. Same is the case with the other expenses, where the expenses has not been paid but they are incurred, then they will be considered as the outstanding. So, what you have to do is you are going to match your expenses with your revenues to know the appropriate profits or the losses of the business. So, what is the significance of this matching concept?
the main significance of matching concept is that we will have to match the revenue and the cost. There are so many types of the transactions are there. They are called the different kinds of the accounts. We do not match the assets, we do not match the liabilities, we match only the revenue and expenses.
So, you have absolutely said correct, sir. When the significance matter comes, it is only one significance is there, learners, that we are going to match our expenses with our revenues to know the exact profits of the business. Together with that, if we are going to adopt that concept in our accounting, even the investors would be able to know that what is going to be the exact profit or losses of the business. They are not going to be misguided by showing the over expenses or by underestimating the expenses, but if we are going to have a proper concept of matching, then the things what are going to be matched. Now, if I go to explain you with the help of an example in this regard, it simply said that profits are going to be earned only when the things are going to be realized, when the transaction has took place, and same is the case with the expenses, that when the event has took place and the expenses are going to be incurred, you should record them in the books of account, and not only when the cash is going to be paid or you are going to receive the cash. I hope that now the concept of accounting concepts are going to be clear, in which we have discussed each and every accounting concept together with its meaning, with its significance, as well as with its example. Now, the learners, once the concepts are clear, it is the time for you to understand the conventions. There are basically 4 conventions which are there in your syllabus. One is known as to be the consistency, other is a full disclosure, materiality, as well as the conservatism, which we are going to discuss one by one. First of all, I would request sir to please explain the meaning of what is accounting conventions.
Dear learners, after studying the accounting conventions, it becomes very necessary to know the accounting conventions. The term convention may not be called as a rule, but it becomes a system by repeated exercises. For example, if you go to a hotel, so after taking lunch or dinner, the bearer comes and after paying the amount, something you give him. It is a convention. It has become a convention that something is paid to the services rendered by him. You are happy and you pay something. That is not a part of the cost.
We can say it's general practices which are going to be adopted from business to business, and it becomes the part of our day-to-day life, and we record the things as per the things.
That is called conventions. It is not a pakka rule. It is not a rule. And we can't say it is a rule, but it has become a part of our life. The same thing we are using in accounting. While we prepare the accounts, something has become very necessary to be taken into consideration while accounts are prepared, and these ideas have become the convention, and these which we will study now, the different types of the conventions.
So, first of all, we are going to start up with the consistency. Learners, consistency simply means that you are going to stick to certain rules and regulations, some methodology of preparing the accounts. You are not going to change the methods of preparing the account day by day or the year by year. For example, when the stock is going to be calculated, normally there are 3 different methods of calculating the value of the stock. One is known as a LIFO method, other is known as a FIFO method, and the third one is the average method. We have already discussed all these three types of methods in our cost accounting, which is one of the optional module. Learners, once you have adopted whatever be the methodology for calculating the value of the stock, either a LIFO, FIFO or an average, you are going to be there on the same track for calculating the stock year after year. Until unless it is going to be very much necessary for you to make the changes, you are not going to make the changes in the method of preparing the accounts. So, companies should choose the most suitable accounting method and treatment and consistently apply them in every period of time. Similarly, changes are permitted only when new method is considered better and can reflect the true and fair view of the financial position of the company. So, learners, what I have said is, in case it is very much necessary for you to make the changes, I will quote with another example. When you are going to calculate the depreciation on the value of fixed assets, there are different methods. Normally, we follow two methods. One is a straight line method, other is a diminishing balance method. Whatever be the method you are following, as per the norms of your business, you are not going to change the method every year. If you are following a straight line, follow the straight line method. If you are following a diminishing balance method, follow the diminishing balance method. Until unless it is very much necessary for you to make the changes, don't make any changes, and this is known as to be the consistency. Am I right, sir?
You are 100%
Would you like to throw
correct.
some more light
Yes,
on this
sir,
regard?
yes. Dear learners, as Dr. Piyush said, the consistency convention means the system or the rules which you have applied once, they should be followed until or unless they are not approved or they are not needed. For this very purpose, as Dr. Piyush said, there are two methods of charging depreciation which are in practice, fixed installment method and diminishing balance method. If you will change without any reason, then the amount of profit of 1 year to another, if you will be comparing, will not show the true and fair position of your accounting. For this very purpose, it was thought or it was considered that the rule or system which you have used once, that should be followed year by year. In this connection, I would like to say one thing more. Sometimes the same method is necessary to be used. Case the take of a mine and another case of one machine and another truck. In truck, you will have to use the mileage system for charging depreciation. In case of the machine, you will have to use the machine hour rate use system. If you will apply that system, then that will not be appropriate. So, this is called prudence also, consistency or prudence. This means the system which you have applied once, that should be followed year by year until or unless it is not changed by the approval of the higher authorities or it is not needed necessarily.
Learners, now I hope this consistency is going to be clear. The second thing, that is a full disclosure. When we say full disclosure, it simply means that each and everything should be properly disclosed in the books of account. Nothing should be hidden. Anything which is going to have a material effects on the results of the business should definitely be disclosed. There may be certain items which are not of that much use. Suppose certain pencils are going to be left at the end of the year, few papers of stationery are going to be left, some other items are left which are of very nominal value that can be ignored of. So, all material facts and figures which may have necessary impact on the result of the business should definitely be disclosed. We are not supposed to hide anything which may have the material effects on the results of the business, and this is the full disclosure convention. Now, I will request sir to throw some more light in this regard.
Right. Thank you, Dr. Sir. This full disclosure convention means everything should be disclosed in the books of accounting, keeping in mind whether it is material or immaterial. If we make a house, we get it constructed, then the main thing is the construction of the house. So many things are used in it, bricks are used, cement is used, but we do not keep the record of all these things. We take into consideration total cost incurred in the construction of the house. The building is the main item. then it will be disclosed in the books of the accounts that this much amount was spent in getting it constructed on that date.
Absolutely.
That is material. You might have seen the books of companies in the balance sheets. If you have seen, in last we see that the 3 digits are 000. There may be some small amounts, but they are thought that they are immaterial, and the balance sheet and other accounts of the companies be prepared in keeping in mind the thousands item. If the transaction is for less than 500, we ignore it, that is treated as immaterial, and the item which is for 500 or more than 500, then we take it as 1000, that is material. So, for this very purpose, for disclosure means everything should be disclosed clearly. If you have purchased two things on a date, one typewriter for rupees 10,000 and you purchase another computer for rupees 50,000. If you do not show, you write only office equipment, that is not correct. The typewriter should be shown at the cost which you incurred, you paid. The computer should be shown in the books of account at the cost which you purchased it.
This is the full disclosure.
Yes, it is known as
everything should be.
It is known as full disclosure.
Now, learners, just two concepts are left with us. One is the materiality and the conservatism. I would like to request sir to please throw the lights on these two conventions also. Sir, what is exactly the materiality convention?
Materiality is this. Just now I told you just before few minutes that material is the main thing. In the office, so many transactions take place. We make the payment for the salary of the employees, we pay the wages to the workers who work in the factory, but the skilled person's payment made is called salary. Unskilled workers payment made to them is called wages. So, it is the material, because the type of working is different. If we say sundry expenses on labor charges, it is not correct. That is how much amount you have paid, that should be shown clearly. It comes under full disclosure, but what is the main nature of the item?
What you mean to say is that as far as possible, unnecessary items should be avoided. Only material facts and figures should be shown.
In daily routine life, in the office, so many items are used like pen, holders, nib, pencil, rubber, etc. But these are immaterial. When we open only one account, that is called a stationery account. It is material.
So that it could be very much clear to the learners,
yes,
and they can understand it in a much more
material and immaterial.
Fine, fine. Sir, now what is this conservatism?
Conservatism. Conservatism is called the which thing was adopted once, that is followed during a very long time in coming days, and moreover we in accounting we keep in our mind under this convention that the expected losses are taken into consideration, but the expected gains are never recorded and considered in the books of accounts, because profit is not sure. The losses may be or may not be, but you will have to keep in your mind that this loss may come to us, for which we have to make some provision. For example, when at the close of the year, when we close the books of accounts, at that time the calculation or the valuation of the stock is very necessary, and stock may be sold in the market at more than the cost for which you purchased, and may be sold less than this price. So, if in practice we take into consideration the value of the stock on the closing date of the financial year, the stock either cost price or market price, whichever is less. So, it is a sign of conservatism.
That we should make some reserve for some unexpected losses which may arise in future.
That's why expected
losses.
Yes.
That's why some reserves are going to be made for provision for doubtful
debts. For example, provision for taxation, provision for doubtful debts. These are the provisions which are necessarily to be paid. So, it is known as conservatism.
So, only the last thing which I would request to please to explain in few seconds, what are exactly the accounting standards?
Accounting standard. Accounting standard, some rules have been framed to be followed by all the accountants or accounting houses or the business concern, so that the accounts may be prepared in the same manner, same way. Previously, there was no rule. One was preparing the accounts another way, another was preparing the accounts on the other ways. Now, everybody, every company, all the organizations which have been registered, they are bound to prepare their accounts on the streamlines given under different accounting standards.
So, learners, I hope that today we are able to explain you the accounting concepts, conventions together with the meaning of the accounting standards. I thank you, sir, for being here with us and providing such a useful information to learners. Thank you very much.
Thank you, sir.